Welcome back, everyone. Today I want to talk to you about something that I have been thinking about very carefully for a long time. And I want to warn you from the beginning that what I am about to share with you today is not something you will hear from your economics professor. It is not something you will read in the Wall Street Journal. It is not something that will appear in any mainstream financial analysis. Because what I want to talk about today is the real reason economies collapse. Not the textbook reason, not the comfortable reason, the real reason. And once you understand it, once this framework clicks in your mind, you will never be able to look at a financial crisis, a war, or a political upheaval the same way again. So stay with me. This is going to be a long conversation, but I promise you it will be worth every minute. Let me start with something called the boom-bust cycle, because this is where every economics textbook begins, and this is also where every economics textbook completely fails you. If you studied economics at university, if you took macro or microeconomics, you were taught that capitalism operates in cycles, that the economy booms, grows, expands, people get confident, people spend too much money, become too optimistic, take too many risks, and then eventually the bubble pops and everything comes crashing down. And then the economy contracts, becomes leaner, more efficient, and then slowly grows again. Boom, then bust. Expansion, then contraction. And the way your professor explained it was with language like natural cycles and market corrections and gravity. The idea being that what goes up must come down. That this is just the natural order of a capitalist economy, the same way seasons change or tides rise and fall. And on the surface, when you are sitting in a classroom and someone draws a wave pattern on a whiteboard and says, "This is how economies move," it sounds reasonable. It sounds like an honest explanation. It sounds like science. But here is the question that nobody in that classroom ever satisfactorily answered. What actually triggers the collapse? What is the precise mechanism? What is the exact moment when a booming economy tips over into a bust? Because if it is truly natural, if it is truly just gravity, then it should be predictable. The way gravity is predictable. The way tides are predictable. The way seasons are predictable. But economic collapses are not predicted by mainstream economists. They never see them coming. The 2008 financial crisis was not predicted by the official economic establishment. The 1929 crash was not predicted. The dot-com collapse of 2000 was not predicted. And every time one of these catastrophic collapses happens, the economists who missed it come out afterwards with very sophisticated explanations about why it was inevitable in hindsight. But none of them predicted it. None of them warned the ordinary people whose savings were wiped out, whose homes were taken, whose jobs disappeared overnight. And I think that gap, that enormous gap between the complexity of the explanations offered after the fact and the complete silence before the fact, tells us something very important. It tells us that the economists who are supposed to understand these systems either genuinely do not understand them, or they understand them perfectly and choose not to tell you the truth about how they work. And today I want to explore the second possibility, because I believe, based on everything I have studied and observed and thought about over the years, that the second possibility is far closer to the truth. Let me introduce you to a different way of thinking about financial collapse. And the framework I want to give you today is this. Financial collapses do not happen by accident. They do not happen because of gravity or natural cycles or collective human irrationality. They happen because someone engineers them. Someone with enough power, enough capital, enough coordination, and enough advanced knowledge of how the system works, makes a deliberate decision that a collapse is more profitable than a continuation. And they have the ability to make that collapse happen. I know this sounds like a conspiracy theory. I know this sounds like something you would dismiss. So before you dismiss it, let me walk you through the actual mechanics of how this works. because I am not going to ask you to believe me on faith. I am going to show you the machinery. Start with the bank. Any bank. You put $1 million into the bank. Simple. Now what does the bank do with that $1 million? The naive answer, the answer that makes mathematical sense, is that the bank lends out that $1 million and is left with zero, because if you receive $1 million and you lend $1 million, 1 minus 1 equals 0. That is just arithmetic. But that is not how banking works. When a bank lends out your $1 million, it does not reduce its own balance by $1 million. Instead, it creates a new deposit. The $1 million you put in still exists on the bank's books as a liability to you, and the $1 million it lent out exists as an asset on its books. The bank has effectively created money, not printed it physically, created it through the act of lending. And this is not a secret. This is called fractional reserve banking, and it is how every bank in the world operates. But here is what most people never fully process, even when they learn this fact. If every bank can create money through lending, and there are thousands of banks across the economy all doing this simultaneously, then the total amount of money in the economy at any given moment is not determined by any physical constraint. It is determined by how willing banks are to lend. And who controls how willing banks are to lend? That is where the central bank comes in. The central bank, whether it is the Federal Reserve in America, or the Bank of England, or the European Central Bank, controls something called the interest rate. And you were taught in economics class that the interest rate is a signal to consumers, that when interest rates are low, borrowing is cheap, so consumers borrow more and spend more, and the economy grows. And when interest rates are high, borrowing is expensive, so consumers pull back and the economy slows. That is the consumer-focused explanation of interest rates that you find in every textbook. But there is another way to understand interest rates that is more revealing and more accurate. The interest rate is not primarily a signal to consumers. It is a coordination mechanism for banks. It tells the thousands of banks across the economy whether to expand lending or contract it, whether to make loans easier to get or harder to get, whether to flood the economy with liquidity or drain it. And when the central bank drops the interest rate close to zero, it is not just saying to ordinary people, hey, go buy a house. It is saying to every bank in the system, open the floodgates, lend generously, release money into the economy. And when the central bank raises the interest rate sharply, it is saying to every bank in the system, tighten up, make loans harder to get. And when you understand it this way, when you understand that the central bank has the ability to simultaneously tell thousands of institutions across the entire economy to either expand or contract their lending, you begin to see that the central bank has the ability to engineer a boom or a bust with remarkable precision. Not by accident, by design. Now let me take you deeper into the structure of power behind the central banks, because this is where the story gets genuinely important. Above the national central banks, above the Federal Reserve and the Bank of England and all the others, there is an institution that most people have never heard of, and that almost nobody in mainstream media ever discusses seriously. It is called the Bank for International Settlements, and it is located in Basel, Switzerland. The BIS describes itself as the Bank for Central Banks. It is the institution that coordinates the central banks of the world. It sets standards. It facilitates communication. It provides a mechanism for the world's most powerful financial institutions to coordinate their actions in a way that no single government oversees, and no public can audit. And here is what is extraordinary about the BIS. It is not a public institution. It is not accountable to any government or any parliament or any electorate. It is a private organization that operates with diplomatic immunity in Switzerland, that coordinates the monetary policy of virtually every major economy on Earth, and that answers ultimately to the interests of the people who control it, rather than to any broader public interest. And what makes the history of the BIS truly remarkable is that it kept operating and kept coordinating international finance, even during the Second World War. Even as Germany was fighting Britain and America, the BIS continued to function as a financial channel between Nazi Germany and the neutral countries, facilitating the transactions that allowed the Nazi war machine to buy the raw materials it needed to keep fighting. Swedish steel, Romanian oil, Portuguese tungsten. The physical machinery of industrialized mass murder was financed through a bank that the Allies allowed to keep operating throughout the war, because transnational capital decided that its survival was more important than the destruction of fascism. And after the war, when you might have expected that an institution so thoroughly compromised by its role in financing the Nazis would be abolished, the Bank for International Settlements not only survived, but became more powerful, more central, more influential, because the people who controlled it needed it to build the new post-war financial order. And that tells you everything you need to know about whose interests institutions like the BIS actually serve. Now let me go back further in history, because I think the roots of the system we live in today are not understood by most people. And I think understanding those roots is essential for understanding what is happening right now in 2026. The year is 1688, and England is going through what historians call the Glorious Revolution. This moment in history is presented in school as a political victory for parliamentary democracy over royal absolutism. And on one level, that is true. But on a deeper level, the Glorious Revolution was a merger, a business merger, between the British Empire and the Dutch Republic. The Dutch Republic at that moment in history was the wealthiest society in the world because it controlled the global spice trade. Dutch merchants had built the most sophisticated financial instruments and trading networks that had ever existed. But the Dutch Republic had a fundamental weakness. It was small, it was flat, it was easily invaded, and it was surrounded by powerful Catholic enemies, including France and the Holy Roman Empire. England, on the other hand, was an island, protected by its navy, much harder to invade, much more defensible. And so a deal was made. Dutch financial sophistication and Dutch capital merged with English military and naval power. And in 1694, 6 years after the Glorious Revolution, this merger produced its most important institutional offspring, the Bank of England. The Bank of England was a private bank, not a public institution, not a government bank, a private bank that was given the exclusive right to issue money and lend it to the English Parliament. And this was a revolutionary innovation in the history of human civilization, because before this moment, if you were a wealthy banker and you lent money to a king to fight his wars, you were taking an enormous personal risk. The king could die in battle. The king could lose the war. The king could simply decide not to pay you back. You had no legal recourse against a sovereign. But if you lend money to a parliament, to a nation-state with a legal system and property rights and enforceable contracts, you are guaranteed to get your money back as long as the nation itself survives. And England was the safest nation in Europe because of its geography and its navy. So the Bank of England created a mechanism through which the wealth of the Dutch Republic could be safely invested in the expansion of English military and commercial power with guaranteed returns. And this mechanism was so successful, so reliably profitable, that it became the model for every major national banking system that followed, including eventually the Federal Reserve. But before we get to America, I want to talk about the ideology that was developed to support this financial system, because every system of power needs an intellectual justification. Every system that extracts wealth from the many and concentrates it among the few needs a story to tell the many about why this is actually fair, natural, and good for them. And the Bank of England and the transnational capital interests behind it were extraordinarily good at funding the development of that story. The philosopher John Locke argued that private property is a God-given natural right, as fundamental as life and liberty. The implication being that any arrangement that protects the property of those who have accumulated wealth is not just legally permissible, but morally required. David Hume introduced skepticism, arguing that we cannot truly know anything beyond our own experience, which conveniently undermines any philosophical framework that tries to ground social justice in divine law or natural law, or any principle beyond individual experience. Jeremy Bentham then built on this with utilitarianism, arguing that the goal of society should be maximizing pleasure and minimizing pain. And since wealth enables the acquisition of pleasure, wealth creation becomes not just acceptable, but morally virtuous. Then John Stuart Mill refined this into the idea of liberty, which in practice means the freedom of capital to move, to accumulate, to invest, to generate profit without interference from governments or communities or moral frameworks that might constrain it. And finally, Karl Marx came along and seemed to challenge all of this, but actually completed it in a crucial way by removing the divine from the equation entirely. Marx said, "The world is not a struggle between humanity and God, or between material and spiritual existence. It is purely a class struggle between those who own capital and those who sell their labor." And while Marx meant this as a critique, what it actually did in practice was confirm the materialist framework. It said the only thing that is real in human society is the economic relationship, which is exactly what the people who run the financial system want everyone to believe. Because if the economic relationship is the only thing that is real, then the people who control the economy control everything. And their control is not a moral failure, or a spiritual crisis, or a civilizational problem. It is just the way things are. Now let me bring this forward to America, because the American story is crucial to understanding the world we live in today. America was founded in part as a rejection of the British financial system. The American Revolution was not just about taxation without representation. It was about whether the new American Republic would be controlled by its own citizens or by the transnational capital interests of the City of London and the Bank of England. And for much of the 19th century, that question was genuinely contested. American presidents, including Andrew Jackson and Abraham Lincoln, fought directly against the establishment of a central bank on the Bank of England model, precisely because they understood what it would mean for American sovereignty. But transnational capital is patient and resourceful, and it works through ages. And in America, those agents had names you will recognize. John Rockefeller, who monopolized oil; Andrew Carnegie, who monopolized steel; J.P. Morgan, who monopolized finance; Cornelius Vanderbilt, who monopolized transportation. These men built their empires with capital that flowed from the City of London and the financial networks connected to the Bank of England. And in 1913, after decades of groundwork, they succeeded in establishing what they had been working toward: the Federal Reserve System, a private central bank for America, modeled on the Bank of England, answerable to its member banks rather than to the American public, with the power to create money and determine the direction of the American economy. And notice what happened in the years immediately following 1913. America entered the First World War in 1917. The stock market collapsed in 1929. The Great Depression followed, and America entered the Second World War in 1941. Coincidence? Or is there a pattern here of a financial system that generates profits through activity, and the most profitable activity of all is war? Now let me talk about 2008, because this is where history becomes directly relevant to your life and to the world we are living in today. To understand 2008, you need to understand something called subprime lending, and you need to understand why it appeared when it did. In 1999, President Bill Clinton signed the repeal of something called the Glass-Steagall Act. Glass-Steagall was a law passed after the 1929 crash that separated retail banking from investment banking. The idea was simple and sensible. If you are a retail bank and you hold the savings of ordinary depositors, you should not be allowed to use those deposits to make extremely risky, speculative bets. But investment banks, private banks that deal with sophisticated institutional clients, can take those risks because they are not putting ordinary people's savings at risk. The repeal of Glass-Steagall removed that wall, and suddenly the largest financial institutions in America became both retail banks holding millions of ordinary people's savings and investment banks making extraordinarily risky speculative bets with enormous leverage. And at the same time that this wall was being removed, money was flowing into American financial markets from every direction. From the Gulf states with their enormous oil revenues, from China, which was accumulating dollars faster than it could spend them, from European pension funds looking for yield, from Japan through something called the yen carry trade, where Japanese institutions borrowed money at 0% interest from the Japanese central bank, and then invested it in American assets yielding 5 or 6%, pocketing the difference. All of this money needed somewhere to go, and the financial industry obligingly created somewhere for it to go. They called it CDOs, collateralized debt obligations. But what it actually was, stripped of the jargon, was this. Banks were lending money to people who could not pay it back to buy houses. These loans were then bundled together, sliced up, given impressive credit ratings by rating agencies that were paid by the banks they were rating, and sold to investors around the world as safe, reliable, income-generating assets. And for years it worked. The housing market kept rising, the defaults stayed low, the profits were extraordinary, and the people inside the system knew, they absolutely knew, that it would eventually collapse, because you cannot lend money to people who cannot pay it back forever. At some point, the defaults have to come. The question was when, and who would profit from the collapse. This is the part of the story that almost nobody tells you clearly enough. In 2007 and 2008, a small number of extraordinarily well-connected financial operators made bets through an instrument called a credit default swap that the American housing market would collapse. John Paulson made $20 billion in profit from this bet. $20 billion from a single trade in a single crisis. And to make that profit, the collapse had to happen. The homeowners had to default. The banks had to fail. The pension funds had to lose their value. And millions of ordinary American families had to lose their homes. And here is the thing about the system that is crucial to understand. The banks could have chosen not to foreclose. When a homeowner stopped making payments, the bank had a choice. It could foreclose, take the house, and realize its loss. Or it could roll over the debt, extend the payment schedule, allow the homeowner to stay in their home, and keep the fiction of the asset's value alive. Banks do this all the time with corporate clients. When a major company cannot service its debt, banks regularly extend and pretend, rolling over the debt rather than forcing bankruptcy. They could have done the same with homeowners. The system did not have to collapse. Bubbles do not have to pop. They pop when it becomes more profitable for the right people to pop them than to let them continue. And in 2008, for the people who had positioned themselves to profit from the collapse, for the people who had bought credit default swaps and other instruments that paid out when the housing market failed, the collapse was enormously, spectacularly, obscenely profitable. And in the aftermath of that collapse, something happened that confirmed everything I am telling you today. The largest banks, the ones whose reckless lending and fraudulent securities had caused the crisis, did not go bankrupt. They were bailed out by the American taxpayer. The losses were socialized, spread across the entire public, while the profits from the bets on the collapse had been privatized, concentrated in the hands of a few. Profits are prioritized, losses are socialized. The Bank of England model, now operating at the heart of the American financial system. And in the years after 2008, as millions of American families lost their homes and were forced to sell their properties at distressed prices, The large institutional investors came in and bought. Before 2008, the vast majority of American homes were owned by individual families. After 2008, institutional ownership of residential real estate exploded. The banks and investment funds that had profited from the collapse then used those profits to buy up the physical assets that ordinary Americans had been forced to surrender. The greatest transfer of wealth in American history. Engineered, deliberate, profitable for a very small number of people, devastating for tens of millions. Now, here is where the story connects directly to the present moment and to the war that is happening right now in Iran. Because after 2008, the global financial system faced a problem. The American economy had been badly damaged. Europe had been badly damaged. The growth engine that had driven global financial activity for decades was sputtering. And transnational capital, the network of interests centered on the Bank for International Settlements, the City of London, Wall Street, and the institutional wealth managers of the world, needed a new engine. And the solution they found was China. Starting right around 2008, the Chinese renminbi began appreciating steadily against the US dollar. This was not an accident of market forces. It was a coordinated signal, communicated through the exchange rate mechanism, telling the world that China was now a viable destination for investment and trade. When a currency appreciates, it means that country can now buy more from the world. It means investors can get a better return by putting money into that economy. And starting in 2008, money began flowing into China on a scale that was genuinely unprecedented. The Chinese government, understanding the signal, began building railways, airports, ports, highways, industrial parks, entire cities, financed by bank loans that created money the same way every bank loan creates money, through the mechanics of fractional reserve banking operating at an almost incomprehensible scale. Today, the four largest banks in the world by assets are Chinese, not American, not European, Chinese. And the Chinese economy went from being roughly comparable in size to America's in 2008 to becoming the world's largest economy by purchasing power parity within 2 decades. This was not an accident of Chinese ingenuity or Chinese hard work, though those things are real and deserve respect. It was an engineered shift in the center of gravity of global capital, directed from Basel, Switzerland, by the institution that coordinates the world's central banks.